calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.
Hey, welcome back to all of our market rebels and to all of our YouTubers out there. This is Coach's Corner. You know the routine. Every Thursday, 4 p.m. right on the closing bell. And speaking of closing bells, Stu, a little bit of a reversal, I think, today from yesterday, huh, in the markets?
Oh, yeah, a little bit. We were up today about $350 in the Dow.
What's on the Dow, yeah.
Percent or something like that. NASDAQ big leader, 2.5% today. So, yeah, wow. Things are looking up today.
Hopefully this is the things to come. But we were just talking about this yesterday on the roundtable.
Kind of depends on if you're long or not, doesn't it?
And that is always true. Before you say that the markets are doing well, you always have to ask if the trader's long or short. But one of the things that we always try to do here on Coach's Corner is to bring you a different perspective of trading. We're not here necessarily to teach strategies, although we will talk about them in the future, but it's more about the mindset. To a professional trader, it doesn't really matter if you're trading covered calls or condors or longs or shorts. It's why are you trading them? And we always get a question, though. We actually got some people asking that yesterday on the roundtable for the best strategies going into 2023. Now, Stu, I noticed, I like your hat there. I don't know if that's to repair the boat propeller or is this a moonlighting job? I think that says home there.
It's my fourth business.
I gotcha. Well, one of the things, I think I know why you put that on, I'm guessing, reading between the lines, because we've often made that analogy when we get this question about what's the best strategy. And we say a lot of times it's like going into Home Depot and saying that what's the best tool that you've got in here, right? I mean, if you were working in Home Depot, how would you answer that if somebody came and said, what's the best tool in the store?
First, imagine yourself, people watching, Bill, imagine yourself walking into Home Depot or Lowe's and saying to the clerk, what's the best tool you got in here?
Right. What's the next question? What's the guaranteed question you're going to get from that person?
What are you trying to do?
Exactly. You know for a fact that's what they're going to ask. And
what's the job? What are you looking to do?
Right.
They're going to tell you, go to the door, leave. What do you mean? We got a billion tools in here. What are you talking about?
Each one is for a different purpose. And to a professional trader, we always say that option strategies and really all of the assets, stocks, futures, options, binary options, they're all tools. They're not done to make something better than another or anything else like that people often talk about. They are tools. And the thing that you have to realize is what is the opportunity that you're after and what's the best tool for doing it? So that's what we're going to talk about today.
What does that mean about that question? What does that really mean about that question? Somebody says, what's the best strategy? It's, and this comes up all the time in coaching. It's the wrong question. It's just the wrong question to ask.
It absolutely is.
There is no answer.
Right.
You can't expect to get an answer.
Or if you give them a condition, under these conditions or under conditions of high volatility or under the conditions that I'm bullish or whatever, but you got to have some conditions.
You got to have some conditions. And even then it's not a absolute, it's never going to be an absolute.
It's never going to be. No. So let's get started with that. I think it's going to be a really good show for us today. But as always, a new little segment that we've added is Chalk Talk, kind of things to stretch your mind, make you think. And today's question, we've got really a two-part question. What's the maximum price for a call option? And then part B is what's the maximum price for a put? Now, Stu, don't answer. We know that you know it. But I want everybody to think about it. And really what this means, stretch your mind. Let's say that the SIBO actually created a zero strike call. And let's say that they gave you an unlimited time to expiration. You made it the best of the best. You could exercise that call, pay zero, and get 100 shares of stock, and you have no expiration date. What is the maximum value that that's worth? That's
Bro, you just gave it away.
That's important for understanding strategy. Same with a put. So I want you to maybe jot down some answers. We'll come back and talk about that at the end, but that's our little brain teaser for today. And as
look,
we've already,
here's a hint. You got to go back to basics on this. It's about rights. What are the terms of the contract? What are your rights and obligations?
That's why it's so important to always go back to those. They will always lead you to or at least to some insightful answers for sure.
Yeah. Yeah.
So today we're going to answer this question, or at least address it. What's the best strategy? Now, Stu, I know back when I was coaching, way back when we were Trade Monster, I used to get this a lot. I used to kind of chuckle about it, and they'd say, you know what? I don't need to know all those fancy strategies. Just cut to the chase. Tell me the best strategy. And I'd
Does that mean, how do I make $300 a day? Is that what you're trying to tell me?
And now, of course, I would say, well, what do you mean? What's the best strategy? They said, well, the one that can make a lot of money, really has no downside risk, tends to win far more often than it loses. And I said, well, if you ever find out what that is, you let me know. Because as you said, it's the wrong question to ask. And if you're asking that question, or worse yet, you're spending all of your time trying to find this holy grail, it's a waste of time. And all it's going to do is to lead you into really bad misperceptions. So Stu, it's in
the same pool as that they. They are
right. They take the prices.
They are taking the stock away from me. They who is it? Who are they? I don't know.
Gotta know. So let's throw the question out. I'm going to start off with a question. Throw it right out of the gates here. Somebody comes to you and says, what is the best strategy? How do you answer and why?
What is the best strategy? Well, the first thing I say to them is, well, what are you trying to do? What is it? Do you have an answer to a direction? Do you have a directional bias? Do you have a time frame in which you're looking to work? Do you have an idea of what your sandbox in terms of money? How much you're willing to lose? If you have an answer to all these things, you can then start to create a strategy, whether it's a straight call, straight put, some sort of a spread. Hey, it might be just buy the stock. They're all tools to help you figure out what is an efficient, and it's never going to be riskless. It's going to be
right.
It may be less risky,
correct,
in an effort to get from point A to point B. And the only way it's going to be the best is after everything is said and done, I'll kind of take a look back and say, well, this would have been the best strategy. But of course, that doesn't really help you. You never really know what the best one is going to be. So stop asking that question because there's no answer. And let's figure out what your goals are and what your aspirations are and what your risk tolerance levels are. And what do you think about the stock in the nearer term or midterm or even longer term? And we'll put together a game plan,
right?
That has we'll call it acceptable risk to you, that can approach or meet your goals. And that's what I would tell people in a coaching session.
Yep. And speaking of tools, you hit the nail on the head with that. It's always about what are you trying to do? What are the risk tolerances you're trying to do? You could say, I'm going to go trim a hedge. If you're going to be standing on a ladder, or a tree, a chainsaw might be faster and it might be more powerful, but you might not be willing to take that risk. Might not be that big of a job. You know what, just to minimize the risk, let me just take a handsaw. There's always a different answer depending on circumstances. And what we've always found is that traders completely miss this. It's always about finding the opportunity first and then applying the strategy. And we find, and I know you get this a lot too, where people want to find the strategy and apply it to everything. It'd be like it's like going into Home Depot saying, oh, somebody told me the hammer is the best tool. You grab a hammer, you come home, and what are you going to do? You're going to walk around looking for stuff to nail. And it's probably stuff that doesn't need to be fixed, but because that's the tool that you've chosen, now you go looking for the opportunities. And that's really what happens when we get people, and I'm not picking on the covered call, but let's just say that they're covered call writers. Now every single problem looks like it's solved with a covered call. And it's really the wrong approach. You have to say, what am I trying to do? What are my risk tolerances? How much am I willing to lose? What am I trying to accomplish? And which strategy, which tool allows me to do that?
So here's a kind of a cool example. It's very current, something that one of our services, my good friend AJ, kind of put out the other day with Tesla. Right, he put out a call on upward bias in the stock. Let's go out and buy the 145s. I think the price was about 4 with the stock around 110. Okay, so that's a strategy. That's a strategy to take advantage of the stock going up. He will relay to people. We kind of think the stock is going here because he looks at his charts. He looks for gaps. He looks for this. He looks for that. Signals, turning, crossovers. And he comes up with, this is where I think the stock is going. That's his magnitude. And he does the cycle bracketing thing. And he comes up with, this is where I think it's going to go in such and such a time. And you could go ahead and you could buy the 145 calls for, I think they were about $4 with the stock at 110. And today, when the stock opened up $10, the call was trading at 6.5, which means you make $2.50. Right. Well, that's pretty good, right? $2.50. Nice. Where's my calculator? $2.50 on 250 divided by 400 is 62%. So now you're patting yourself on the back and you're saying 62%. Wow, that was the best strategy. But I say, all right, hold on. That was a strategy. Maybe it wasn't the best. How about if you went out and you bought 100 shares of stock? If you bought 100 shares of stock and you got to sell it up $10, you made $1,000.
$1,000.
So let's do that. So now I made $1,000. Let's see, what's that? 1,000 divided by 110 is 9%. So now I made 9%. So but
you made more dollars.
But you made more dollars. I made less percentage. This is kind of a 2-fisted, 3-fisted, 4-fisted question and answer session. Like, which is better? I don't know. Which is better? Would you rather make the money or would you rather make the percentage? Me personally, I'd rather make the money, but Absolutely. It doesn't come free. Right. It comes with a lot more downside risk. There's always going to be that trade-off. So there's no like, hey, I shoulda, woulda, coulda, unless it's after the fact and then it's shoulda, woulda, coulda. But when people say that, it's like, hey, they're not thinking about the risk that they would have had to take in and the probability of the pricing of that particular option and so on and so on and so on. So, which one was best? I don't know. What do you think was best, everybody out there? Was it better to buy the $110 stock, or was it better to buy the $145 call?
Or buy two of the 150s. There's all kinds of
150s, or buy 4 of the 145s for a similar delta. Or if I think it's 5, it was 5. It was like no, it was 4. It's like a 4-to-1 ratio. And then if it's a 4-to-1 ratio, look, 4-to-1 ratio on a 25 delta is 100 deltas.
Still 100.
That's
deltas.
The same as 100 shares of stock.
Correct.
But you don't get your gamma on the stock. So look, if all these terms are like, going nuts from all this language, hello, you need a coach. You need to learn the language.
Right. Because that's what it is. It's more about finding the opportunities and understanding how do we apply the strategy to the opportunity. Because again, we find so many people that look for the magic strategy and then, I'm just a covered call seller. I only do credit spreads. I only do condors. I only do this. And they don't really have an underlying reason for doing that. So now here's another point, Stu, that I have found that people always get wrong. And it's super important for you as traders to understand. I'm going to bring up a little analogy or a little example here, a little graphic. And so here's our seesaw. Let's say that I'm going to make you the offer, Stu, to you can win $100. We're going to flip a coin. If you win, you get 100. If I win, you're going to pay me 100. And
okay, so I like this game.
First question I have for you: what's the value of this game?
Wait.
Now, also, let me back up for a second. I know some people right off the bat are going to say, "Oh, wait a minute, that's gambling, and I don't gamble, and so therefore it has no value." That is not necessarily true because there are potential cash flows. The question that you always have to ask as a trader, I mean, it's certainly your right to say, I don't want to take that much risk, but you can't look at this and say it has or that you think it has no value, because if there are potential cash flows, positive cash flows, it has value. So what is the value of this one right here, though,
Nothing.
as it stands? Ooh, very good. I knew you'd get that right. This actually has no value if it's a 50-50 shot.
Ask me how I know that.
How do you know that?
Because I've figured out somewhere along the way, and I don't know if it was last year or 40 years ago, but somewhere along the way, I kind of figured out that this whole thing that we do here and market pricing, it's all about probabilities
Yes.
of movement, of outcomes in the future. And that
Correct.
the world, you want to call it markets, market forces, us bad guys, maybe the market makers, price opportunity.
That's right.
That's how I know the answer.
Yep.
Go ahead. It's even money here.
Right. It's even money. The odds are even. That sounds odd, but it is true that we have even odds here. But this is why, little side note, this is why if you trade futures contracts, there's no cash outlay up front. There's no expected cash flow. Now, you might have what's called an initial margin, which is really a good faith deposit, but it's not because you have an expected positive cash flow.
Yeah, that's a different story.
That's a whole different story. But now the point is, let's say that we change this game. And I'm going to make it to where your loss is 1/5 the size. Now the question becomes, what happens? Is there now a positive expectation for you?
You trying to tell me I got to pay now?
You're jumping to exactly right. I knew you'd get it. That's correct. What happens now? See, the professional traders are going to see immediately. Yes, there is a huge benefit, but anytime you use the B word, benefit, in the markets, it follows by the P word, pay. It absolutely is going to be accounted for. So what happens? Yes, this is where traders go, oh, look, I've got all these cash flows up here. Or they're expected to get bought out for this amount. There's a benefit. That's true, but everybody does what? They now have to bid that price higher. And for those who have had physics will know that the left side here has to be 5 times as wide as the right to make that balance.
Right. And in our business, it's the market that's equalizing this.
It's the market that's equalizing.
The price. It's the price.
The price is that little balancing point, again, what's called the fulcrum for all of the physicists out there. And but it is going to balance. And the thing that you want to take from this, one of the main keys, is that when you are trading, price is the equalizer. Anytime somebody tells you that a strategy has a benefit because of this, that, and the other, fine. Understand it comes with a higher price. And that price negates that benefit. That's why you can't say that there is a best strategy. Now, the price here in this case would actually be $40. For those who want, this is what we call a pay model. So let's assume that you played this 10 times. You would pay $40 10 times. You're out $400. Half the time, you're going to win. That should be 0.5. Half the time you're going to win, 5 times you're going to win $100, so that's up 500. And 5 times you're going to lose 20, which is minus 100. So there you go. You're going to net out to 0. Now, if we wanted to flip it and say, well, wait a minute, let's do this as a bet. So that we
How can I get an edge? Where's my edge, guys? Where can I get the edge to play this game?
Right. Now,
how can you incentivize me to try and play this game? If it's set up like this,
there is none.
How am I going to win at the end of 1,000 rolls?
There's no reason in the world to play this game as it stands. And yet part of what we're trying to show here is people will say, well, wait a minute, I can win 5 times as much as I can lose. What a fabulous strategy. It's the best strategy in the world. Let me continue playing it. There's no reason in the world whatsoever to play this game at all.
Which is, by the way, side note here, don't worry too much about your batting average.
Right.
That's what this is, right? It doesn't matter.
It doesn't really matter. It's always
it'll help you a little bit, to kind of balance things out a little bit, but it shouldn't be your concentration.
Right. Now, sometimes people say, well, wait a minute, what if we didn't do this as a pay game where you had to actually pay money up front? What if it were just a bet? Well, in this case, you've got 5 to 1 magnification in your returns. That's 4 to 1 odds against you. And look at that. There's your 4 to 1. You would have to pay 1 to make 4. Or in this case, if you were on that side, you have to pay 4 to make 1. And so it doesn't matter how you cut it. The math always comes out that if the market has priced it correctly, that's really the big question. That's where the opportunities lie. It's not about saying this strategy is better because I can win 5 times what I can lose. And I hear that all the time from traders.
Yeah.
Oh, this condor, I can make 8 and I can only lose 2. What a wonderful risk reward ratio. Not necessarily true. It could be absolutely horrible.
I'll do the other side of that every time.
Exactly. Yeah. This is where a lot of times people go, why would the market makers take the other side? So we'll talk about that. Let's do some other examples, but real quick, little plug. Remember, for anybody who wants to take their trading to the next level, check out marketrebellion.com/get started. Lots of free courses and videos on there to help you out. So now, next question for you, Stu.
Hold on. Let me throw a little tip out there.
Of course.
When you're trying to think about a trade and how it will react, or think about the other side of the trade.
Exactly.
Right? For every trade, there's another side to a trade. Otherwise, there wouldn't be a trade.
There wouldn't be a
There's
trade.
always 2 sides to a trade. So instead of getting so wrapped up in like what you think might happen, try and take the other side. What will happen? And sometimes that will lead you to be able to see a clearer vision of an outcome.
Right.
That's
right.
all.
And I know you've talked about this on some of the floor trades where you'll say, oh, this option expires in a day. Somebody wants to buy these puts that are 50 points out of the money for 10 cents. You just go, oh, there's a low probability of that happening. Let me just sell a ton of them. You have to back up and go,
I've done that.
Why?
I did that.
Why would somebody want to buy these? You always have to, and that, like, you're right, that will give you a different perspective. So let's get back talking about probabilities, because here's another mistake that traders make, or a misperception.
And hold on. And if the unexpected or the 2 or 3 or 4 standard deviation move happens on my position, and I have the other side of it, what's going to happen? Am I out of business?
Right.
Am I losing more than what I really should be allowing myself to lose? Am I putting myself down 50% of my account, 20% of my account on one trade, 10% of, you have to live in a sandbox. You have to live within confined, what's the word I'm looking for? Confined limits of risk and consequently of reward.
Absolutely.
And if you're looking at, if you know how to use an analyze tab, which I highly suggest everybody learn how to use, and you're looking at that number down 2 or 3 or 4 standard deviations, or up 2 or 3 or 4 standard deviations, and you're like, oh my God.
No way that's going to happen.
Don't do it.
Wrong approach.
Even though your theory on paper looks excellent based on a probability, there's always the rest of the other side of the probability always exists as well.
That's very well said. Now, here's another question that I've heard other people, a lot of traders, we get this a lot in Q&A, but here's a straight up question. I'm going to make it a simplified one. If you sell a call for $5, right? So your market maker, you've sold this call for $5. That's the market price. What is your expected gain on paper? Ooh, I'm trying hard, folks, to stump him. He's putting up I don't know if you could, he's putting up the big goose egg there. Now, if you ask most people, I would guess that most people would say your expected gain is 5, because I'm putting $5 of cash in my pocket.
Yeah, don't get that confused with what your max gain can be and all that.
Right. The question is, think about the P word, price. Why is somebody willing to pay $5? We just saw it. Because there's an expected $5 of gain.
That's right.
If there's an expected
that's
$5,
why it's $5,
or at least what's called an expected value of $5, they should be willing to pay $5. If they think, oh, I can get it for 4, who's going to sell it to you? If they're expected to make 5, why would I sell it for 4? And if I want to sell it for 6, why would you buy it?
I think every option trader should be required, before they can hit the enter button, to read at least a couple of chapters on expected values.
Absolutely true.
I think it would really help.
Yep. And we're going to talk about those in the future. Well, now let me
Yeah, we
flip
will.
it as well. What if you bought this call for 5? Is that going to give you an edge now? What's your
Dude,
expected
it's the
gain
same.
now?
Isn't it the same trade?
It is. Correct. And you just, why would the gains change if you're just
They're
flipping
not. The market doesn't care about me, Bill.
market doesn't care whether you're the buyer or the seller. The question is, if you sell a call for 5, part of your covered
Yeah.
call, you shouldn't say, oh, I've got this, I can make whatever, maybe it's an out of the money call. I can make $5 of capital gains or $10 of capital gains, plus I can make this free $5. Wrong approach. What is your expected gain from sell? I don't care if it's 10 points out of the money. For $5, your expected gain is 0.
Zero. It's
And
zero.
that's
It has to
telling
be
you
zero.
that it's
Otherwise,
the
it
reason
would be priced at $5.
it wouldn't be priced at
gain
$5.
the gain that you might get from it is tangential. It has
Yes.
nothing to do with it. It's
Correct.
after the fact. It's based on what happened over a period of time with respect to applied volatility levels, interest rates, dividends, stock price movement, all the things that make up that thing called the pricing model.
Absolutely. Let's do a little trickier one here, Stu. Let's say that we have, talking about fair value, I'm going to take 10 numbers. I'm going to bring out a little magic hat here, and I'm going to pay you $100 if you draw the numbers 1 or 2. So you got a 20% chance of winning. We're going to throw them in there. Now, what is the value of this game? And again, I don't want the people out there to think, oh, there's no value because this is gambling. If I offered it to you for free, there should be no reason in the world to say no, because you might win $100. In fact, you're going to do it 20% of the time. So what should you be willing to pay?
How much?
20% of 100. We got 100%
20%?
reward.
What should I be willing to pay, or what would I look to pay? Which is the question.
Well, what should you be? What's the theoretical value? What's the fair value of it? Yeah,
20.
There you go. 20% of 100. So theoretically, he should be willing to pay 20. Because now, if he does, the fair value over time is going to go sideways. It does not go in a straight line like a lot of people think. There's a lot of volatility and variation around it. But do you see how overall that's a sideways trend? That's very characteristic of a fairly valued game. But now let's say that somebody says, oh, look at all the money I could make. I could make $100 and I'm going to pay $21. Look what's going to happen over time. See, they go completely about it the wrong way. They say, here's how much of a reward I can make. Who cares?
You're paying more than an expected value.
You're paying more than the expected value. And what we
Makes
would
no
say,
sense at all.
none. I don't care how big the reward is. What we're saying is that this arrangement is a bad deal. Now, that doesn't mean you can't beat it.
Isn't that how Steve Wynn was able to build Wynn Resorts?
They make a few bucks every year. Exactly right.
Right,
Positive
because
edge on
people
there.
are paying 21 on an expected return that's lower.
Right. Correct.
What's that number on the roulette wheel? 5.25%?
About roughly, 5.26.
Five and a quarter. Every time you spin it, man, you're just, every $100, you're pissing away $5.
5 cents. You're throwing it up for 5 per 100. Now let's flip it over here. Let's say that you were able to get this for $19. See, now it becomes interesting. And yet some people would say, oh, wait, I got to pay $19 for this.
Looks like Bill is frozen. Or is it me?
I don't know if I just froze.
Go ahead, you're back.
Are we back on right now?
Yeah, you're good.
Oh, okay. So I was just saying that if you were to pay 19, this would actually be a good deal. And yet some people might look at this and say, oh, I got to pay 19 for the strategy. That's a way. It's always about what is the expected value? What's the opportunity or the edge? Now, you brought up an interesting comment earlier when I first brought up that game. And you said, what should I expect to pay or what would I be willing to pay? Again, spoken like a true market maker. What would a market for you would probably look something like this. We know the fair value of this is $20. You're going to bid 19, offer it at 21. So what does that mean? If I come in as an outsider, a retail trader, and I want to sell for 19, and I go, ooh, I can put 19 bucks in my pocket. Look at this. And I can also make some capital gains. What a great deal. Wrong. It's a horrible deal. Or somebody comes in and says, I want to buy it for 21. You have to sell it for 21. And I go, ooh, for 21 bucks. Look at this. I might make $100. Fine. It's a horrible deal. They will keep doing this all day long. It is not about the size of the rewards. It's not about the raw amount that you pay or that you receive. It's what is the relationship among all of them.
It's about it's respective of one another. It's about the pricing. This is what the pricing model does. The pricing model is reflective of what the world, the markets, whatever you want to call them, thinks about the future.
Right.
That's what really implied volatility is. I mean,
cut
through all the noise and minutia and the weeds and all that. It's just the best guess about the future.
It absolutely is. So
nobody knows. Yep. Listen, hey, here's an example. Take Tesla, right? Crazy stock was 200, now it's 100 a month later. Look, if I said to you, let's price a straddle a year out. I mean, that's like a tough thing to do.
That's a really tough thing.
I'm going to price a straddle on a stock, on a monster stock like Tesla a year out.
Right.
But we do it. We do it based on historical averages of pricing, of how the stock has behaved in the past, of pricing principles of one option relative to another option. And this is how it's done. And sometimes
and also hedge the risk, along the way, which is what the market makers are able to do. So the thing that we want everybody to take from here, if there's a single lesson, is to understand that options, really all assets. A lot of times people think, oh, you never trade stock because you're an options trader. Not true. If I want delta 1, gamma 0, I'm trading stock.
I trade stock all the time.
Yeah, stock is an option with a zero strike. Which
yes,
we're going to
it
answer
is.
in a little bit. It is an option. You could certainly mathematically look at it as an option. It's just a question of, do I want the strike that low? And so what we're trying to do is to show you a different perspective of to get out of this mindset of saying, oh, I want to learn this strategy because it's the best, or because it has a great risk-reward ratio, or it wins all the time. Those don't exist. What you have to do is learn how to find the edges and then construct your portfolio and hedge the risk. So
the edge might be in the implied volatility. You would see it in the implied volatility.
Right.
If you're looking at a matrix and it's going and the matrix is going 20, it's skewing up 20, 22, 24, 29, 26, 25. Hey, I want to sell that 29 volatility option. There's your edge. It shows up in the implied vol. It's just the price. And it's just another way of saying what the implied vol is. So we look at the implied vol because the price is the price, but it's depending on how much time it is, what's the price of the stock, all that kind of stuff. But the implieds are relatively constant relative to historical data. So you can measure variations away from a mean.
Right. So we've also often talked about it like with football games. You might say that an upcoming game that your team has a 7-point spread against it. As an options trader, coming from this kind of a naive view, they would say, oh, I should bet on that team because they're expected to win. But there's another P word, a point spread. And that serves exactly the same purpose as price in the markets. Your expected gain is 0. That's the whole reason for having the spread. And so as an options trader, what we want to do is just to teach people to get out of the mindset of trying to hunt for the perfect strategy that can get you all the capital gains and put some free money in your pocket. The question is, what are you trying to do and how do you find your edge? And so for some ways to do that, we'd like to invite you to check out Market Rebellion /get started, marketrebellion.com, that is /get started. Now, one thing to wrap up here, Stu, maximum price for the call, maximum price for the put. What is the maximum price for our call option? Oh, there's the...
Oh my God, there's Roscoe.
I'm so sorry, everyone. Yep.
The maximum price for a call, we kind of already gave the answer. It can never be more than the price of the stock.
That's exactly right. Even if you had, I am so sorry, everyone, big sign on the door, please don't ring the doorbell. So what do? Ring the doorbell. But yeah, the maximum price is the stock, because ultimately you're just going to convert it into shares of stock. That's the very best it could ever be.
Read the terms of an option. It delivers
100 shares of stock. So why would you say I want to pay 101 for stock worth 100? Right. That's the very best it could ever be worth. Now, the reason that's important is that if you are trading, let's say, stock replacement, and it's a $300 stock, and people say, oh, the stock is $80 for this high delta option, that's way too much for an option.
The option's $80.
It's less than a quarter of the price you're trading the shares.
Sounds pretty cheap to me.
They've got super cheap, but they don't have the right perspective. So for the price of the put,
start looking at percentages. When it went from 80 to 60, so I lost $20 on 80, and I'm down 25%. But
it's still $20.
$20. That $20 on the $400 stock is what, eight or something, 8%, and that would be okay. But the other one's not okay.
Right. Yeah, because they look it up from a different base. It's still 20 points. So the second question, what's the maximum price for a put, would be the strike price. That's if the stock goes all the way to zero. And this is really important for strategies, which we'll talk about in the future. Let's say if you're trying to play the upside on the VIX and you want to get a stock replacement strategy, you can't find a call option deep enough in the money. But you could maybe sell a very far in the money put, which would still give you delta 1, and yet you've got a floor of maybe 10 points, assuming the VIX is down at 10 or 12. And so now you've got a natural floor in there because you know that that's the maximum. But people never think of this because they're always just trying to find what's the best strategy instead of the right tool. So I hope that helps everybody.
I could sell like a 90 or 100 delta put, and I could be like long stock. Is that what you just said?
I think you could do that. It's amazing how that works. So anyway, I hope that gives people a different perspective. That's what we want to do here. And again, I'm sorry for the mad dog Chihuahua out here. But anyway, so I think any final comments, Stu?
Yeah. Always look at your probabilities. Try and determine to the best of your ability what your probabilities of an outcome are. Bad decisions can have really good outcomes.
Very well said.
It doesn't mean it's the right decision, because if you do the bad decision enough times, as Bill showed, you're going to wind up being a loser.
Right.
Good decisions can have bad outcomes.
And that's true too.
That, again, doesn't mean that you did the wrong thing.
That you did the wrong thing. Yep.
Right?
It's about finding...
But
it's having that confidence of saying, I know that I'm doing the right thing. I know these are the edges. That was just kind of a fluke that it happened to turn out against me.
Yeah, you got
People
lucky.
don't know
right?
that. They say, oh, I got burned on that covered call. I'm never, ever doing it again, because they're looking for the perfect strategy. And the main thing to know is they don't exist. So I hope that gives everybody a
call thing. I mean, we got to talk about that again some other time. We're kind of out of time here, but that's a whole other topic that we really need to address.
And we'll do it. So anyway, I hope you picked up some good tips. That's what we want to show. Hopefully we're going to see the market continue to rally, assuming that you're on the long side. And then we'll look for you next Thursday. We'll see you then.